It is time for Ask Annex. Here we go. And again, if you got a question, you head to our website, look for the Ask tab. We get back to everybody. If you want to remain anonymous, that's fine. And if you don't want your question answered on the radio, that is fine as well. In the studio, Sarah Kyle, a wealth manager at Annex Wealth Management. Hello.
Hello, Danny.
We've got Matt Morzy, investment team manager here. Hey.
Hey, Danny.
Our first question is from Craig. Will the 60/40 portfolio come back from the dead this year? It's been dead, huh?
Yeah, I think last year in 2022, that was certainly the story of the year, or at least something that, if you went to Yahoo or MSN or Google Finance or any of those, you had articles on the 60/40 all year. And really what that came to is that it was a year where both stocks and bonds went down a lot, which typically doesn't happen at the same time. Usually if stocks are down, bonds usually hold their value pretty well, and they're uncorrelated or have a low correlation to each other. But last year, with rising interest rates, bonds got killed just as much as stocks did. So it's a year that a lot of people were trying to move away from that. When you're looking at a forward metric standpoint of is it dead in or is it going to come back, is what are the potential future returns from each of the two asset classes? So we have stocks now that are trading at a lower multiple that they were going into 2022, and you have bonds with a higher yield now than they did then as well too. And so you're at a spot where you actually see a better outcome moving forward from the 60/40 than you would have thought a year ago. You also have the add-on to not only getting a higher yield on some of those longer-term bonds, but if the Fed is going to cut like the market thinks it's going to, you have the chance of capital appreciation with your bond as well. So they actually look pretty attractive. And this is something actually we talked about recently on one of our SWAT podcasts, is that the 60/40 actually looks pretty attractive right now. This is one of those topical type of things that comes up when you have a historically non-normal time period, which is what we just experienced. Over the last 10 years, and this is according to Vanguard, the 60/40 averaged 6.1% per year in the last 10 years, ending at the end of 2022. So even with a horrible 2022, you still got 6% a year. When they're using their forward metrics to put out their capital assumptions going forward, assuming the higher yields that we have now, potential gain in bonds, they're actually saying that you're going to get a higher 60/40 return over the next 10 years than what we just experienced. Now, we don't know if that's going to happen. We'll see in 10 years if that's true, but it actually looks more attractive now, according to Vanguard, than it did before.
Next up is from Kyle. What are the main differences between active and passive investments?
There's a couple different ways to look at that. So passive, or what people usually refer to that as kind of like an index investment. So you're just going to buy the S&P 500. And it's a passive because you're just making that decision to do that. You're just going to let the market do what the market's going to do. Active is where you have somebody who's actively trying to beat the market. So whether using the S&P 500 as a benchmark, you have an active manager, usually inside of a mutual fund, trying to make stock picks to beat that index. The other way to look at that too is you could be passive by picking an ETF that has a set strategy to it. Maybe it's tilted in a certain direction, but it's not necessarily having an active manager picking stocks. So it's kind of a hybrid between the two as well. But active is somebody trying to beat a benchmark. Passive is generally a benchmark, and there's some variations off of that as well too.
And with that comes different fee structure too. So the active manager is typically going to have that higher fee, and the passive investment strategy is going to have a lower cost.
A lot of times passive investing might have 0.02% or 0.03% because all they have to do is set the benchmark and then forget it. And then they rebalance once a year along with the benchmark. So there's very little work to go into it. And then the active is trying to beat it. So they're charging you for their research, for their staff. They're charging you for all those things in order to beat it. So it's important to look at the net expense of what you're going to pay, but then what the returns are net of those fees.
It's Ask Annex. Got a question for us? You head to our website, look for the Ask button. This one is anonymous. Is there a tipping point between taking on enough risk to achieve my retirement goals, but not so much that I'm risking my future financial security? Boy, that's a big question, Sarah.
Yeah. Well, yes, there is a tipping point between those. But the amount of risk that you take really depends on several factors, including your investment goals, your time horizon, your risk tolerance, as well as your risk capacity. We talk about this all the time. So after you determine that, then it's important to have that financial plan constructed, and that will be a nice roadmap to help you determine how much risk you should be taking.
Final question real quick, and we get a lot of them on AI, artificial intelligence. Is everybody falling all over themselves trying to get into these investments?
Well, I feel it's exciting when progress presents us with new innovation. But just like the internet, when that internet came on the scene, the dot-com bubble, there were winners and losers. Thousands of companies that went out of business and did not survive. And AI companies will be the same way. There'll be winners and losers. You got to do your homework and know what you own. But these companies will transform the way we do business and create new opportunities and challenges for both companies and individuals. Just do your homework, know what you own. We'll see how it all plays out.
Yeah, I think one of the funny things to watch with this is the change of times that it gets mentioned within companies' earnings calls. So there seems to be a lot of trends when over time in these calls, and they'll highlight this on CNBC or other news outlets where they'll go through and take the transcripts and find out how many times a word is used quarter to quarter. And so a year or two ago, it was metaverse and through every single one of these earnings calls. And now it's AI. In fact, they played like a couple minute segment the other day where it was just highlights of different people that were on CNBC over the last few months saying the letters AI over and over and over again. And it's just amazing to see all of a sudden that's the new buzzword that's talking. It's certainly something that looks like it's going to change how we do things, as you mentioned. But like you said, there's going to be winners and losers. And right now, everyone wants to play the AI game. Some of them have even changed name of the company, their ticker symbol, all those things to get people to think of them as the AI company or doing that. So it's going to be really fun to watch.
Mm-hmm. Sarah Kyle, Wealth Manager, Annex Wealth Management. Thank you.
You're welcome.
Matt Morzy, Investment Team Manager. Thanks.
Thank you.